Return measures. Returns refers to what an investor receives for having put in money. Total return is equal to the sum of regular income and the capital gains. To compare investments, the invested amount and the time period over which the investment is evaluated have to be comparable. Using simple absolute returns which compares the returns to its investment value, investment A has performed better. Using simple annualized returns which compares the returns to its investment value and holding period, investment 2 has performed better. Simple measures of ROI do not take into account the time value of money, which refers to the fact that a rupee received today is not the same as another rupee received 6 months from today. The standard that is used in the financial markets for calculating returns for a period more than a year is the compounded annual growth rate, or CAGR. It considers the time value of money. A CAGR of 11.08% per annum does not mean that equity grew by 11.08% every year. It would have grown at varying rates each year, but the smooth average of growth over a period is 11.08%. MS Excel can be used to compute CAGR. An investor invested in a mutual fund and his transactions are shown in the table. He likes to know his return on the 14th of June 2012, when the value of his investment was 140,000. Enter the relevant dates in date format and enter the transaction amount for each day against them. For cash outflows, enter negative values. Compounded annual growth rate is the standard for representing returns for holding period more than a year. Returns of a portfolio are weighted average returns of the assets in the portfolio. Time-weighted returns eliminate the effect of the cash flows and is used by MF portfolio managers to showcase their performance. On the other hand, money-weighted rate of return emphasizes on the contribution and withdrawal in a portfolio and are used for client portfolios. Holding period return is the return generated by a portfolio between 2 points in time and suffers from endpoint bias. Periodic returns shows the consistency of portfolio returns over the period is more useful in evaluating portfolio performance than holding period return. Helps evaluate consistency over the period as well as magnitude of returns. Rolling returns shows a range of performance across blocks of time. They capture market behavior and also impact of fund managers' investment calls, if any, for those periods. The impact of highly favorable or unfavorable events or market situations also becomes visible in measuring rolling returns.